Filing for bankruptcy feels like the end. It feels heavy. It feels embarrassing. It feels permanent. You look at your credit report and see the word bankruptcy attached to your name. And you think, that's it. No lender will ever trust me again. No bank will approve me. No card issuer will say yes. But here's the truth. Bankruptcy is not the end of your financial life. It's a reset button. It's not a life sentence. It's a structural restart. And in many cases, it's the most honest financial reset a person can take. Instead of drowning in minimum payment, you clear the state and regain control. The problem is not the bankruptcy itself. The problem is what most people do after. They either avoid credit completely out of fear, or they over-apply trying to fix it fast. Both approaches slow the comeback. In this video, I'm going to walk you through a clear, structured 5-step plan to rebuild your credit after bankruptcy. No hype, no unrealistic promises, just strategy. Because rebuilding after bankruptcy is not about speed, it's about stability. My name is Therese Tsague. I'm the founder of America Credit Care, and I help people rebuild credit through structure instead of emotion. Bankruptcy can remove debt pressure. It can stop lawsuits. It can stop garnishment. It can provide relief. But it does not automatically rebuild your score. Bankruptcy removes debt. It does not rebuild trust. Rebuilding trust takes structure. And trust in the credit world is measured through consistency, not declaration. Today, I'm going to break down what bankruptcy fixes, what it does not fix, the exact 5 steps to rebuild, how to use credit safely, the biggest trap after bankruptcy, and a realistic timeline to reach 700 and above after bankruptcy. Let us start with clarity. What bankruptcy fixes? Bankruptcy can discharge qualifying and secure debt. Credit card, medical bill, personal loans. It can stop collection activity. It can stop lawsuits. It can eliminate overwhelming balances. That alone can reduce financial stress dramatically. It can also reduce your credit utilization to 0 if revolving debt is wiped out. Lower utilization can actually create room for rebuilding. Bankruptcy removes pressure that matters. It also gives you something powerful, a clean starting point for future behavior. You are no longer juggling 5 delinquent accounts. You are rebuilding from 0, not from chaos. That clarity is leverage. What bankruptcy does not fix. Bankruptcy does not rebuild positive payment history. It does not add active trade line. It does not increase your credit age. It does not automatically raise your score. And it does not remove bankruptcy record itself. The bankruptcy will remain on your credit report for years depending on the chapter. That sounds intimidating, but here is what matters. Scoring model weight current behavior more than older events. A bankruptcy from 2 years ago with perfect rebuilding behavior is viewed differently than a bankruptcy with continued late payment afterward. Time reduces impact. New positive behavior increase strength. That is where your comeback begins. Step number 1, clean report review. After discharge, pull full credit report from all 3 credit bureaus. Review every account. Ensure discharge debt shows 0 balance. Ensure they reflect included in bankruptcy. Ensure there are no duplicate trade line. Ensure no creditor continue reporting past due status after discharge. If accounts still show balance on, that must be corrected. Accuracy matters. You do not rebuild on inaccurate data. You rebuild on a clean foundation. This step protects your reset, and it prevents lenders from misinterpreting unresolved debt that legally no longer exists. Step number 2, open a secure card strategically. You need active positive reporting. The safest way to begin is with one secure credit card. A secure card requires a deposit. That deposit becomes your limit. This is not about borrowing heavily. This is about reporting activities. Use the card lightly. Keep utilization under 10%. If your limit is $300, do not report more than $30. Pay before the statement close. Let a small balance report, then pay it off fully. This builds fresh positive stories. Consistency matters more than amount. One card is enough to start. You do not need 3 immediately. In fact, too many accounts too quickly can signal instability. Control growth builds credibility. Step number 3, add an installment account if needed. Credit mix matter. If your bankruptcy wipe out installment loan, adding a small credit builder loan might help diversify your profile. This could be a small secure loan where payment are structured monthly. This is not mandatory for everyone, but installment accounts show structured repayment ability. They demonstrate that you can handle fixed obligation over time. When used responsibly, they strengthen your profile depth. Make sure payments are automatic. No miss one. Post-bankruptcy, 0 late payment is non-negotiable. Your comeback depends on clean history. Step number 4, budget lock system. This step is psychological. Bankruptcy often happens because of income disruption, medical event, divorce, business loss, or debt spiral. But if spending patterns remain unchanged, rebuilding becomes fragile. Budget lock means creating fixed spending categories, fixed saving goal, fixed debt usage limit, living below limit, avoiding lifestyle inflation because new credit line will eventually increase. Higher limit without discipline create risk. You rebuild stability by strengthening cash flow first. Strong cash flow reduces dependency on credit. Control increase long-term approval odds. Step number 5, time and patience. Time compound. 6 months of perfect payment create momentum. 12 months build credibility. 24 months build strength. Many people see score back in the mid-600 within 1 or 2 years of discipline rebuilding. 700 and plus is realistic with consistency, but only if you avoid common trap. You cannot rush time, but you can maximize what time does by protecting every single payment. Every month is a data point. Every on-time payment is a signal. Those signals accumulate. Now, how to use credit safely after bankruptcy. Never max out credit cards. Keep utilization low. Do not carry unnecessary balances. Auto pay minimum always. Pay statement balance in full. Avoid emotional spending to celebrate approval. Approval are tools, not reward. Also, avoid using credit as income replacement. If cash flow is tight, adjust expenses before increasing card balances. Credit should support stability, not substitute it. Here's the biggest post-bankruptcy trap. Trap number 1, over-reapplying. Getting approval once feels good, so people apply again and again. Too many inquiries reduce stability. Trap number 2, high utilization. New limit feels like freedom, but high usage signal risk. Trap number 3, missed payment. One missed payment after bankruptcy damages credibility significantly. You are rebuilding trust. Protect it. Trap number 4, closing new card quickly. Age matters, so keep account open in good standing. Trap number 5, co-signing too early. Helping someone else before your profile stabilizes can create new risk. Rebuild your foundation first. Realistic score expectation. Immediately after discharge, score may be low. Within 3 to 6 months of difficult activities, improvement begins. Within 1 year, many see significant growth. Within 2 years, strong profile emerge. The bankruptcy remains, but its relative weight decreases as positive data grow. Consistency beats speed. Structured patience beats emotional urgency. Lenders understand bankruptcy happen, medical crises happen, economic disruption happen. What they evaluate is behavior after. Do you have stable income? Do you have lower utilization? Do you have on-time payment? Do you show discipline? Are your accounts seasonal? Bankruptcy does not automatically disqualify you forever. Recent behavior matters more. Underwriter look for recovery pattern. Show them one. Building toward 650 and 700. To reach 650 credit score, focus on on-time payment and lower credit utilization. To reach 700, focus on maintaining lower balances, aging account, and avoiding unnecessary inquiries. To go beyond 700, continue adding controlled debt. Higher limit with low usage. Longer account age. Clean history. Sequence matter. You cannot rush age, but you can control behavior. What most people get wrong about the comeback. There is something important that rarely gets discussed. After bankruptcy, many people become hyper-focused on the number. They score, they check it weekly, sometimes daily. They measure progress emotionally. The lender does not approve based on emotions. They approve based on risk pattern. And risk pattern is built through behavior consistency. Your comeback is not about chasing a score. It's about building a stable profile that makes approval predictable. That means no new late payment, no high utilization spike, no sudden application burst, no financial chaos. Bankruptcy actually gives you something powerful, a clean behavioral slate. There are no lingering 120 days late dragging behind you every month. There is space, and space allows structure. Another mistake people make is to compare their rebuild with someone that never failed. That comparison is unnecessary. Your timeline is your timeline. What matters is forward motions. 6 months of stability is progress. 12 months of perfect payment history is power. 20 months of discipline change how lenders view you. You are not rebuilding from weakness, you are rebuilding from reset. And reset used correctly can produce a stronger foundation than before. Because now you understand risk, you understand limits, you understand consequences, and that awareness is leverage. And leverage combined with structure creates momentum. Momentum creates approval 1 month at a time. That is how the comeback becomes real. Bankruptcy removes debt, it does not rebuild trust. Rebuild trust requires clean reporting, secure card use, installment structure if needed, budget discipline, and time. That is the 5-step comeback plan. Not dramatic, not flashy, structured, stable, predictable. When you respect the sequence, progress becomes inevitable. If you need help rebuilding after bankruptcy, click the link down below and book your personalized credit section with America Credit Care today. We help you rebuild with structure because structure creates leverage. And leverage creates approval. Move with knowledge, not shame. That's how you win. Thank you for watching.